Hi, David here. To buy or not to buy? Many Australians have an emotional attachment to property. This is understandable given the long period of price growth that has occurred since the mid-1990s. When considering residential property as part of a diversified portfolio, investors should think about the following. 1. Is the return generated equal to the risks undertaken? If your property investment generates net returns after expenses that are lower than the classic super safe investment option, the term deposit, you need to reconsider the validity of the investment. Any investment involves a trade-off between risk and return. If alternate assets provide a better risk-return profile, then property may not be the immediate answer. Number 2. If your circumstances change, do you have an exit strategy in place? If you lose your job or can no longer fund the investment property expenses, you need to have a backup plan in place so that you're not forced to sell in an unfavorable market. Access to savings or a line of credit can buy you time in such situation. Number 3. Does the investment generate income or are you relying on speculative capital growth? Many property investors undertake a negative gearing strategy in the hope that housing prices will continue to rise indefinitely. Australian residential property markets are relatively immune to big falls in property prices experienced in the United States and Europe during the global financial crisis. This does not mean we will be so lucky when the next recession comes along. Often the best property investments are those that generate enough income on a standalone basis without the need for capital growth. Buying is exciting and scary at the same time. So ensure you minimize your risk and maximize your potential profits. Do all your research needed? Talk to a financial planner or an accountant. Who knows? In time to come, we may see you on a cover of one of those glossy property investment magazines. Let us know what you think.